You know what billionaires are buying? Gold, Bitcoin, real estate, stocks. Everyone knows this. Financial media covers it obsessively. Gold hits $4,000 per ounce, and every outlet reports that hedge funds are accumulating. Bitcoin approaches $100,000, and the narrative is that the ultra-wealthy are diversifying into crypto. Real estate markets surge, and we're told billionaires are snapping up properties. This is the public narrative, the mainstream story, the assets everyone talks about. Everyone analyzes. Everyone thinks they understand. But here's what they don't tell you. While financial media obsesses over gold and Bitcoin, while retail investors chase the same assets billionaires bought 5 years ago, the ultra-wealthy have already moved on. They're accumulating 3 assets you've probably never heard of. Assets so obscure that most financial advisors couldn't explain them. Assets so essential that they'll become more valuable than gold when the system breaks, and they're doing it quietly. No press releases, no CNBC interviews, no tweets. Just systematic, relentless accumulation through shell companies, private transactions, and legal structures designed to hide ownership. I'm going to show you exactly what these 3 assets are. Why billionaires are accumulating them right now in 2025, and how you can get exposure to the same assets without needing $1 billion. The first asset billionaires are buying is farmland. It's not just any farmland. It's a specific farmland in specific regions with specific characteristics that most people don't understand. And the person who's accumulated more of this asset than anyone else in America is Bill Gates. As of 2025, Bill Gates owns approximately 275,000 acres of farmland across the United States. That's 430 square miles. Larger than Los Angeles. Through his investment firm, Cascade Investment, he owns more private farmland than anyone else in America. He's been accumulating it systematically since 2013. But Gates isn't just buying random farmland. He's buying very specific types of land in very specific locations. Gates's largest holding is in Louisiana. 69,071 acres in the Mississippi River Delta. Why? Because that region has 3 characteristics that make it irreplaceable. Superior soil quality, deposited over millennia by river flooding. Limited water access from massive aquifers and river systems. And one of the longest growing seasons in America, some land produces 2 full crop cycles per year. His second largest holding is in Arkansas. 47,927 acres. Rice and soybean country with direct access to the Arkansas River. Water intensive. Crops in a region with guaranteed water supply. Third is Nebraska. Farmland directly above the Ogallala Aquifer, the largest underground water reserve in North America. Gates bought land where the aquifer is deepest and recharge rates are highest. Guaranteed irrigation for the next 100 years. Washington State. 14,097 acres in the Columbia River Basin. Perfect climate for wheat, potatoes, and fruit. Unlimited water and infrastructure for shipping crops to Asia. Florida. 14,828 acres. Citrus, vegetables, and cattle. Year-round growing season, aquifer access. Every purchase follows the same pattern. Superior soil quality that can't be replicated. Guaranteed long-term water access from rivers or deep aquifers. Climate conditions that support multiple growing seasons or premium crops. Gates isn't buying land to farm it today. It's buying the capacity to control food production when global food systems break down. Gates is still actively acquiring. In June 2025, he bought another 2,800 acres in Benton County, Washington, for $131.4 million. That's $16,000 per acre. Average farmland in America sells for $3,000 to $4,000 per acre. Gates paid 4 times the national average. Why? Because the land sits in the Horse Heaven Hills region. Crop circles with pivot irrigation already installed, direct aquifer access, perfect climate, and most critically, mineral rights and water rights included. Which brings me to the second asset. Asset 2. Water rights. Not water itself. The legal right to extract and use water, and this might be the most valuable asset class of the 21st century. In the western United States, water rights are separate from land ownership. You can own 1,000 acres but have no legal right to use the water underneath it or flowing through it. Water rights are allocated through prior appropriation. First in time, first and right. Whoever claimed the water rights first, usually ranchers and farmers in the 1800s, has senior rights. In times of scarcity, senior rights holders get their full allocation first. Junior rights holders get whatever's left, which is often nothing. Water rights can be bought, sold, and transferred separately from the land. If you own senior water rights where water is becoming scarce, you're sitting on a gold mine. The most famous example is Boone Pickens. In the 1990s, Pickens started buying land in the Texas Panhandle, not for the land, it's for the water underneath. The land sat above the Ogallala Aquifer. Pickens assembled water rights to extract 65 billion gallons per year, enough water to supply a city of 1 million people. In 2011, he sold a portion of those water rights to 11 Texas cities for $103 million. Not the land, not the water itself, it's just the legal right to pump water. That's $1.58 per 1,000 gallons. Cities pay pennies per 1,000 gallons from traditional sources. Pickens made a 10x return by simply controlling access. Still owns the majority of his water rights, currently valued at over $500 million. But Pickens isn't alone. There's now an entire industry of Wall Street firms buying water rights across the American West. Water asset. Management has been buying farmland in Colorado specifically for the water rights. They've acquired over 2,500 acres along the Colorado River. The land itself is worth maybe $50 million. The senior water rights are valued at over $300 million. Their strategy is explicit: profit from water scarcity. They buy land with senior water rights, make the farms more efficient so they use less water, then sell the excess water rights to cities and developers desperate for water. In California, the Resnick family owns the wonderful company. Pistachios, pomegranate juice, mandarins, but their wealth comes from water. In the 1990s, the Resnicks began buying farmland in California's Central Valley, tens of thousands of acres. With the land came water rights. In 1994, California held meetings about water management. The Resnicks were there. Most cities weren't paying attention. Those meetings resulted in regulations that allowed private entities to control water banking. Water banks are state-built facilities that store water during wet years and release it during droughts. Built with taxpayer money, but private companies could control who gets the stored water and at what price. The Resnicks acquired control of the Kern Water Bank, the largest water storage facility in California. Capacity of 1.5 million acre-feet, about 500 billion gallons. During droughts, the Resnicks sell water from the bank at massive markups. They've made billions by controlling access to water stored in public infrastructure. In 2021, the Church of Jesus Christ of Latter-day Saints bought 2,200 to 2,500 acres of farmland in Washington state for over $200 million. They outbid Bill Gates' company. Why? Water rights. That land comes with senior water rights on the Columbia River system, guaranteed water forever, and it gets more aggressive. In 2021, Crown Columbia Water Resources filed to acquire private water rights throughout the Columbia River watershed. Their plan was to buy water rights from farmers, bank them, then lease or sell that water to cities and developers. This would have been the largest private water rights acquisition in American history. After public backlash, the application was suspended, but the company didn't disappear. They're still buying water rights quietly through smaller transactions. Water rights in the American West are being consolidated into the hands of billionaires and investment firms. Climate change is reducing snowpack in the Rockies. The Colorado River flow has dropped 20% over the last century. The Ogallala Aquifer is being pumped faster than it recharges. Whoever controls the water rights in 2030 will be wealthier than whoever owns oil. Because you can live without oil, you can't live without water. The third asset is truly obscure. Most people have never heard of it. Most financial advisors couldn't explain it. But the ultra-wealthy have been piling into this at record rates in 2025. Catastrophe bonds, cat bonds, a financial instrument issued by insurance companies to transfer disaster risk to investors. Here's how it works. An insurance company covers properties in Florida against hurricane damage. If a major hurricane hits, they could face billions in claims, more than they can handle. Traditionally, they'd buy reinsurance. But reinsurance is expensive with limited capacity, so they issue a cat bond. The insurance company creates a special purpose vehicle. That vehicle issues bonds to investors. let's say $500 million. The $500 million sits in a collateral account invested in treasury bonds. The insurance company pays investors a premium, typically 5% to 10% above treasury rates. If treasury bonds yield 4%, cat bonds might pay 9% to 14%. No hurricane hits that year, investors get their principal back plus the premium. But if a hurricane hits and causes more than a specified amount of damage, say $10 billion in insured losses, the cat bond triggers. The $500 million gets transferred to the insurance company. Investors lose their principal, bond defaults. You earn high returns betting catastrophes won't happen. But if they do, you lose everything. Who would invest in this? Billionaires, pension funds, hedge funds, and sovereign wealth funds, because the returns are extraordinary and the risk is uncorrelated with everything else. In 2024, the average return on catastrophe bonds was 17.4%. Compare that to the S&P 500, which returned about 7%. Now, cat bonds nearly tripled the return of stocks. In 2023, cat bonds returned 19.8%. During the market meltdown of 2025, when Trump's tariff policies caused the S&P 500 to drop 15%, cat bonds went up 1%. While stocks crashed, while real estate fell, while even gold dropped briefly, cat bonds held steady. Why? Because tariffs don't cause hurricanes. Trade wars don't cause earthquakes. Stock market crashes don't create floods. Cat bonds are completely uncorrelated with economic cycles. This is what billionaires understand. True diversification isn't owning stocks and bonds. Those are both correlated with the economy. True diversification is owning assets whose performance is independent of economic cycles. Cat bonds are the purest expression of that. The cat bond market has grown explosively. As of November 2025, the total outstanding market is over $50 billion, up from $33 billion in 2020, a 50% increase in 5 years. In the 12 months from August 2024 to July 2025, insurers issued $23 billion in new cat bonds. It's the highest issuance year in history. Why? 3 reasons. Climate change is increasing disaster frequency and severity. Insurance premiums are rising, so cat bond coupons go up. Okay? And investors realize cat bonds provide genuine diversification. In 2022, stocks and bonds both fell simultaneously. A 60/40ths portfolio got destroyed, but cat bonds were up 5% that year. Who's buying them? Dedicated insurance-linked securities funds like Farmland Capital Management, Plenum Investments, and Stone Ridge Asset Management. Pension funds like CalPERS, Canadian pension funds, European pension funds, Middle Eastern sovereign wealth funds, multi-strategy hedge funds, allocating 5% to 10% to cat bonds. Asset managers like PIMCO, MDay, and BlackRock. Even reinsurance companies like Swiss Re and Munich Re. Over 1997 to 2025, cat bonds have generated yields that exceed their expected losses by an average of 4 percentage points per year. Average cat bond pays you 4% above what's justified by the actual risk. Why? Because investors demand a premium for unfamiliar risk, and the market is still relatively inefficient. Example, in 2011, a cat bond called Mariah recovered tornadoes across the U.S. It paid investors 6.25% per year. If industry losses from tornadoes exceeded $825 million in a year, the bond would trigger. Historically, tornado losses exceeded $825 million once every 10 to 15 years. So investors were being paid 6.25% per year to take on risk that might materialize once a decade. Except 2011 was the deadliest tornado season in U.S. history. Over 983 tornadoes, $21 billion in damages. Industry losses hit $954 million. The bond triggered, investors lost the entire $100 million. But even accounting for that loss, investors who held a diversified portfolio of cat bonds over 2010 to 2020 still earned an average return of 11% per year. Because most bonds didn't trigger. It's a probability game. If you hold a diversified portfolio, you will occasionally lose money when disasters trigger bonds. But over time, the high yields more than compensate. and the returns are uncorrelated with stocks, bonds, and real estate. In 2025, the cat bond market is undergoing a structural shift. Historically, 75% covered hurricane risk in the U.S., but in 2025, issuance is diversifying. Earthquake risk in Japan and California, wildfire risk in California and Australia, flood risk in Europe, even mortality risk from pandemics. And 58% of cat bonds are now issued by primary insurers like Allstate and State Farm, up from 48% 2 years ago. They're bypassing reinsurance and going straight to capital markets. This means cat bonds are becoming mainstream infrastructure for the insurance industry. The market is deeper, more liquid, and more diversified, which is exactly when smart money floods in. Billionaires are positioning now before retail investors figure it out and before yields compress. Why these three assets? Farmland with water access, water rights, and catastrophe bonds. What's the common thread? They're all scarce, essential, inflation-proof, and disaster-resistant. Scarce. You can't create more farmland with premium soil and water access. You can't create more water rights. They were allocated in the 1800s. You can't make more disasters. Catastrophe risk is fixed by geography and climate. Essential. Food, water, and disaster insurance are non-negotiable human needs. When everything else is optional, these three are mandatory. Inflation-proof. When currencies devalue, farmland prices rise because food prices rise. Water rights become more valuable as scarcity increases. Cat bonds pay floating rates tied to inflation. All three maintain real value regardless of currency debasement. Disaster-resistant, farmland survives economic crashes, survived the Great Depression, survived 2008. Water rights survive everything. Disasters make them more valuable. Cat bonds are literally designed to survive disasters. They pay high yields precisely because they're uncorrelated with market crashes. When stocks collapse, when bonds default, when currencies fail, these three assets keep producing value. Billionaires aren't accumulating these for 5% annual returns. They're accumulating them as wealth preservation for the next 50 years. They're positioning for a world where currencies are unstable, food is scarce, water is expensive, and traditional financial assets are volatile. These aren't get-rich-quick plays. They're civilization-level hedges. How do you get exposure without being a billionaire? For farmland, the easiest access is Farmland REITs. Farmland Partners, ticker FPI, owns 177,400 acres across 300 farms. It pays quarterly dividends, about $11 per share. Gladstone Land Corporation, ticker LAND, owns 168 farms on 112,000 acres. Pays monthly dividends, about $15 per share. Another option is fractional farmland platforms like AcreTrader and Farm Together. You can invest $15,000 to $50,000 in a specific farm. You own a fractional share and receive a proportional share of crop revenues. For water rights, there's no public market, but indirect exposure exists. Water utilities like American Water Works, ticker AC, water infrastructure companies like Xylem, ticker XYL, water-focused ETFs like Invesco Water Resources ETF, ticker PHO. For catastrophe bonds, there are mutual funds and ETFs. Stone Ridge High Yield Reinsurance Risk Premium Fund, ticker SHRIX, Pioneer Cat Bond Fund, ticker CBYX. These give you exposure to cat bonds with daily liquidity. The downside is fees of 1% to 2% per year. There's also the Swiss Re Cat Bond Index, which several ETFs track. This isn't financial advice. I'm showing you what billionaires are accumulating and why. Whether you follow is your decision based on your risk tolerance and financial situation, but understand what's happening. The ultra-wealthy are moving capital out of traditional assets and into real, scarce, essential resources. They're doing this because they believe the financial system as currently structured is unsustainable. And when it breaks, the things that matter are food, water, and disaster protection. Not stocks, not bonds, not even cash. Bill Gates didn't become the largest private farmland owner by accident. He did it systematically over 12 years. Boone Pickens didn't stumble into water rights worth $500 million. He bought them when nobody else understood their value. Pension funds didn't allocate billions to cat bonds because they were bored. They did it because traditional diversification failed in 2022. The pattern is visible. The trend is clear. Question is whether you see it in time to position accordingly. When you see billionaires systematically accumulating boring assets that seem irrelevant to the current market, pay attention. They're not buying for today. They're buying for the day when everything else fails. And on that day, the person who controls food, water, and risk transfer will be far wealthier than the person who owns stocks and bonds, denominated in a currency that no longer functions. That's not doom and gloom. That's pattern recognition. Every reserve currency in history has followed this path. And every time the wealthy who saw it coming moved their capital into real assets years before the transition. This is that moment. Whether you act on it is your choice.